Hi, before we begin, here's a quick note. This video is for entertainment and educational purposes only. It's not financial advice. I'm just sharing the things that I've learned, not telling you what to invest in. The S&P 500 was up almost 18% in 2025. Great year, right? But many European investors looked at their portfolio and they just saw it grow by 3 or 4%. Same market, same companies, very different result. So what happened here and where did all the money go? Let's ground this with a real example. The S&P 500 returned about 18% and that's in US dollars. Now take a very popular ETF in Europe, iShares Core S&P 500 ETF with the ticker symbol IE00B5B MR087. Many European investors held this. They return roughly 4%. Same companies, same index, but there is a huge difference in returns. The reason was in the stock market. It was the currency. The euro strengthened, the US dollar weakened. So when US stocks went up, the currency conversion pulled returns down for Europeans. The interesting point here is the stocks didn't underperform, the exchange rate did. This doesn't just affect one ETF, it applies to US stocks, US ETFs, US index funds, and even US bond funds. Anything priced in dollars. If you are earning in euros but investing in dollars, currency becomes a silent partner in your returns. It's sometimes helpful and sometimes painful. So, what do the European investors do now? One option is currency hedged ETFs. For example, iShares S&P 500 Euro hedged ETF. These funds try to cancel out currency movements. You get closer to the pure index return without the euro dollar noise. But hedging isn't free. There's a cost and it changes the long term behavior. Here's the part that really surprised me. A stronger euro actually means Europeans are relatively richer globally. But as investors in US markets, they feel poorer. What if the tables turn? What if euro weakens in the future? The whole effect flips. Unhedged investors suddenly look like geniuses. So, the last year wasn't a bad year for US markets. It was a reminder that returns don't live in isolation. Markets move, currencies move, and sometimes the difference between 18% and 4% isn't the stock that you bought, but the money you are measuring it in.